Hello, hello. Good morning, good afternoon.
Hi, good morning. Anybody else on the line?
Sorry, say that again, please.
Yes, good morning.
Morning, morning. All right, I see some. Jill, is this your first time joining in this meeting, or have you joined earlier? I am not sure if I've seen the name. That's what I was wondering.
Yeah, that's correct. It's my first time joining this I think meetup.
Okay. Welcome, welcome. So what are
Thank you.
you going to get out of this? You're gonna spend, a couple of hours here. So what's your expectations?
I'm just trying to get an understanding of these what's discussed. If this is kind of like a summarized version, kind of like an earnings call of the companies. I guess I'm just trying to get an understanding because this is my first one and just kind of listening in and see if this is something I want to listen in on every week. This is a weekly meeting, right?
Yeah, we meet every week. Yeah. Cool. Yeah, I think this week, because we had now it's earnings season is kicked off, so I will talk about a few earnings, you know, that came across my radar. But generally, we look at what's happened in the market. Sometimes, review some companies, earnings season. We'll talk about earnings, talk a little bit about crypto, essentially focusing on, I don't think anything is off topic when it comes to the investing for do-it-yourself investors. So we're not a professional investors or hedge fund managers or financial advisors. We're just do-it-yourself retail investors focused on
Yeah,
making most of whatever we have. So
correct.
that's
I understand. Okay.
yeah, that's the focus. I say good afternoon to you, Rameshji. Thank you for joining in. Can we go over selling short contracts with sufficient stock? So, Sam, are you talking about option contracts? Is that what you're referring to?
Yeah. I sold some oh, I didn't even have the shares at that time, but I sold Baba, and I'm very nervous because you said people buy those contracts kind of randomly, and then so luckily, well, I don't know if they've been exercised, but I've since bought shares. But then I have thousands of shares of me, if thousands of shares of I got Rivian and then another stock that I should have been selling shares to earn money while it's in the deep negative. So can we
So,
just go over it?
so you're referring to you're holding shares, then you want to sell option on it, I'm assuming.
Yeah, sell put contracts because
Right.
I don't, because the likelihood of the shares being exercised is close to none. But I figure that's actually why I bought a 23andMe, Rivian, well, not real, well, 23andMe, thousands of shares, but it's actually negative, so I might as well play with it, right?
I mean, 23 and me probably, there's nothing left in the company. If you looking, track your 23 and me stock, all the uh,
So if it's at 45 cents, 40 cents, should I buy in the call 40-cent put options or 50-cent put options?
no, so as you know, I don't buy options.
Oh,
Right.
sell.
Yes. So I don't have a correct answer for you because it depends on what's your outlook for 23 and me. So what's the ticker for
It's
23
not
and
going to
me?
go anywhere. Just like remember Neo, you sold enough contracts to be to have your cost basis under zero. So
Yeah,
I think, yeah,
so because I want to hold Neo for long term, I mean, that's what I've been reducing my cost basis. It is less than zero because I want to hold it. I am still bullish about Neo in terms of, their business. And 23 and me, first of all, I'm assuming that you really want to hold the stock 23 and me in your portfolio.
Well, I mean, like I think I have a thousand shares or so, so I have
Okay.
10 contracts. So do
Okay.
I?
So if you have a share, maybe then you can come and, it's not much optionable. There is not much of a volume. It's not even a good stock.
Well, no. So if I sell a contract, do I do it at 40 cents or 50 cents?
No, you have to look for what's the price you want to pick up. Let's say I opened like 23 and me, right?
Uh-huh.
So you now the stock is trading at $4.91, right?
45 cents.
No, it looks like they did a reverse split.
Oh, they did?
Yep, it looks to me like that because it's
Well, no, no, just an instance. You don't have to go into it. But do you buy in the money? You mean,
no,
uh,
I sell generally out of a money at a price point where I may be okay to let some of the shares get called away.
okay, so if it's at 45 cents or $4.50, I would sell it at $5, right?
Now $5 is still close to in the money. Maybe sell at $6. You might get 20 cents for it or 25 cents for it.
Okay, so sell it a lot. Don't be close to the price.
I mean, if you want to get rid of your stocks, then get close to price, then you have a higher chance of those stocks getting called away. But if your intention is that I would just want to reduce the cost basis and just wants to get a premium, then go little out and
So
then
60 cent, $6, not $55.
yeah. So
Okay, well,
before you
thank you.
do
That's all.
that, I'll tell you go and maybe review this video, right? Call options and monthly income strategy.
Okay.
So there we talked about how you pick up your strike price. Maybe you want to get closer. If your idea is to generate income and just reduce the cost basis, go further out of money. If some cases where I'm done with the stock and I just want to, I'll be okay if it gets called at a current price, then I'll go add the money. Rare cases I will do in the money. Right? But we'll make sure, yeah, review the call options session that we done.
Okay, well, thank you.
Cool. All right, let me put this link here in the chat. All right, by the way, 23 and Me, I think there were some developments in 23 and Me. All the independent directors of the company quit. Everyone on the same day, they just quit because the CEO and the founder of 23 and Me, is it Susan Wojcicki? Or am I confusing with someone else? So she wants to take the company private
Yeah, 45,
and
40 cents.
yeah, she wants to take the company private because they had to do a reverse split when the stock falls down less than $1. Nasdaq has certain rules. You can get some reprieve for a few days, for a few months, but then you have to make sure the stock stays above dollar. But the whole idea was independent directors wanted, in their fiduciary role, they have to look for the shareholders. So they wanted to maybe go out and find out if anyone else is interested in buying 23andMe. But CEO, she didn't want to do that. So she didn't, and she has a super voting shares. So now you can't do anything about it. And then all the independent directors, they just quit the company. So now, if you're interested in 23andMe, make sure you know where Susan Wojcicki, where she eats, where she goes, what her schedule is, what she likes, because now the whole company is dependent on her whims and fancies. I hope companies' business model, which they try to pivot to, which is around helping pharmaceutical, not helping pharmaceutical company, they actually wanted to become a pharmaceutical company, which is why I think the stock has done what it done. Now this one, where did I go? Let's look at 23 and me. Let me just remove these.
Look, if I sell it at I sell it at $6, 60 cents or $6. I make up to sell 2 contracts. I make up half my investment. Geez, that's pretty good. I should be more active on this.
Yeah, that's why I love selling options. It allows me to stay long on my shares and hold it, especially the shares that I want to hold, right? I just don't want to hold the shares just because I can sell options. I will look at the other way around because I want to hold the shares, and that's why I'm selling options. So let's look at this 23andMe for last, oh, it's been in public market for even more than 5 years. So let me go back and look at 10-year data. Okay, so I think this is where it went public, right? So we are looking at what, $237 was the highest. So looks like went public to $200 and now it's $4. So wealth incinerator this company has been. Like, didn't make any money for shareholders. So this was in 2021, right? In the height of all the mania around all the new tech companies, free money. This is where it, closed, it came public. And now it's down, what, 98%. I mean, there are many other companies that have been down 98%, but the reason why it went down is, from being a capital light to now capital intensive business of trying to create becoming a pharmaceutical company, it needs a lot of money. Yeah, it's not easy to find a new drug. Yes, if you become successful, you're gonna make tons of money, but the success rate is so slow, and it will continuously need to feed capital into it. So I don't know. Maybe Susan, I mean, she probably can run it on her own. She has enough dollars, uh, whatever, but that's where it is. So she's gonna take the company private, and then so that they don't have to worry about reporting to shareholders and all that stuff. But I'll be careful. Um, and I don't know, once it is taken private, then obviously it won't be trading on exchanges, maybe only in OTC market, so even will be less liquid. So I don't know those mechanics, how they will work, but that's where her plan for 23andMe is. Ramesh said, don't fall in love with this company when all employees quit. It was all the directors, not employees, but all the independent directors on the board, because they say, hey, there is, if company has to be run just by the CEO, then why do they need us? And she said, I want to run it the way I want to. So obviously now she'll bring in the other board of directors, which are, in her pockets, I guess. But yeah, that's a risk. What else before we jump onto regular stuff? Anything
Uh,
else?
Thank you. That sounds like Donald Trump.
Let's not go over there. Two areas where I want to stay away in this meeting is our religion and politics. Those can be very divisive discussions. Okay, any other stock? Something new that I have a question on before we jump on to today's. Well, let me see if anyone.
Hi, Vivek. I know ASML dived a bit. I joined a bit late.
So we're gonna cover ASML when I look at the earnings for ASML. So that's already on agenda.
Awesome.
I'm
Thank
gonna
you.
review the earnings of it's like a tale of two semis, because ASML and TSM both are in the very, very important player in the semiconductor. And you can believe, if you just look at the earning results, that they both belong to the same industry.
Yeah.
So it was like a tale of two sideways, completely opposite stock reaction. In one case, the stock is up like 16, 17%. Other case, it's like down almost the same amount. So we're gonna talk about ASML.
Awesome. Thank you.
Cool. Anyone else here joining for the first time? Let me go through the names. Vishal, Is this your first time here?
No, I've been on this call a few times.
Sorry, my apologies. Maybe I missed the name.
Uh,
Right. Right. So what brings you here?
I've been following you for some time, so in general, the discussions are quite interesting.
Okay. All right. All right. So I hope you've been benefiting, and that's why you're coming. So thank you for joining in and spending a couple of hours every Saturday. All right. Looks like no other questions. So let's dive into today's session then. All right. Welcome everyone. This is our 252nd or whatever 252th session. Coming every weekend, Saturday, spending time. So appreciate you guys all spending a couple of hours, little more than a couple of hours every weekend to talk about investing. So what do we have on agenda today? We have earnings season has been kicked off in earnest now, and this week, couple of companies at least that I hold in my portfolio reported results, ASML and TSMC, and may not be the household names because these are not Mac 7 and not the companies that are actually producing consumer facing goods that you directly buy it, but pretty important company from a perspective of anything that we do and in today's life is dependent on chips, and these companies are indispensable when it comes to the chip industry. So I do want to go through the earnings of these two companies. And then we also have one pending item from our previous week, which was to look at IBM. So we will start our discussion by, we'll looking at IBM as a company. And I guess IBM is also going to report the results this week. So probably it's timely for you to know what you want to do with IBM. If you're interested, if you're not interested, neutral, whatever. So we'll talk a little bit about IBM. And as usual, little bit on overall market, like on the crypto side. That stuff also is on fire this week. So we'll talk about that. A few things that caught my eyes from a news perspective, etc., etc. All right, if you have a questions, put it in the chat. I do monitor the chat as we go along, and we'll pick it up, move it from there. With that, let's dive into today's session. As always, anything that we discuss here is not an investment or financial or tax advice, though we may talk about, I mean, we talk about finances and all that, but do your own due diligence. I have some ideas which I want to share, but that applies only to me, right? Not to you. So make sure you take those ideas and frame your own decisions. All right.
Hey Vivek, this is Satish here. Quick question.
Sure.
Last week I was not able to attend. Are there any videos which I can go through?
So I do upload all the videos on on the website. So if you were not able to attend last week, so you can comment it. Hold on, let me just give the.
And do we have access to this Word document which you usually go through?
So yes, the videos up out here. So you can come and get all the previous video.
Thank you.
All right. Sometimes I'm late in posting the video. In that case, just email me or ping me on Slack. I get tied up in other things, but at least as of last session, I'm done. Generally, I try to post it by end of Sunday, but sometimes it get dragged down to Monday, etc. In that case, yeah, just ping me on Slack. All right, so let's dive into today's session. I want to start with something, food for thought. I was just thinking about it because I looked at some of the Mag 7, maybe 6 out of those 7, and that got me thinking that investing is simple, but it's not easy, right? How could both be true? What's your thought? How could both be true? I mean, it's not complicated. If you were not investing in, I mean, whenever we start, we think it's you need to have a PhD, if not PhD, at least a master's degree in finance to understand the stock market, or maybe you should be working in a financial services industry, right? For you to get started in investing, it's for whatever reason we don't teach it in the schools. And you know, when kids start working and you start and you are really not sure on, you know, how to proceed on investing, I think it's too complicated. But as we move along, at least I've noticed that it's nothing complicated. It's pretty simple, right? You don't need to, if you don't want to, you don't need to know, you know, any financial um, ratios. You don't need to know how to read balance sheet or cash flow statement, or you don't have to follow out any earnings, you know, week after week, oh sorry, every quarter, just by simple ETFs and let them do the work for you. It's pretty simple. Investing is simple. Given the fact that now we have online brokerage firms, you don't have to call up your broker and tell them that you want to invest. You can just go and set up automatic investment. Your money in your 401k coming in just by low cost, I mean 401k, whatever the lowest cost broad-based index options that you have from investing, you know, mutual funds you have available. Just buy that. It's pretty simple, but it's not easy to stay to invest for a longer term, right? It is because even though SPY on an average, broad-based index on an average returns 10%, right? Average doesn't mean that it's gonna just go up 10% per year, right? So it's gonna, Vishal said that emotions will bring the worst of the people, right? That's exactly what happens. That's the very difficult part when it comes to the investing. I think that is more difficult than trying to find out the next big thing, the next big shot, the next Googles or the Metas of the world. You don't understand tech, you don't know what's going to be the next Google, fine, not an issue. You're not big into crypto, you don't know which coin next to pick, that's fine, right? You don't need to be expert in any field. There are, especially in US, there are so many ways to invest in broad-based market, in the economy. You know, there is no excuse. There is no excuse. So I actually picked up you know, now in hindsight, it looks like, gosh, if I had just invested in Apple, Amazon, Microsoft, Google, Nvidia, we would have been millionaires by now, right? Last 10 years, these stocks have performed uh, amazingly. So Nvidia is up almost 30,000% in last 10 years, right? Apple, Microsoft are up 800%. I show the chart, and you know, there are other stocks that are up like 600%. I think Meta is up 600%. So it's a pretty, for someone who had bought these shares 10 years ago, right? Maybe they just happened to talk to someone and then there's someone told, you know, hey, looks like you are using Facebook. That time it was Facebook stock. You using Apple gadgets. You might have thought, you know, hey, I'm buying it. My friends are buying it. So there is a market for these companies. Maybe I should buy some shares also. Maybe this time instead of upgrading my iPhone, I want to put those dollars into Apple shares, right? And if you bought those 10 years ago, pretty good deal. But what you have to go through that is what Vishal mentioned, which is like fear and greed. Look at the fear. Meta has been down 75%, right, from its recent high. These are the gut-wrenching periods which you have to go through if you really want to have these big winners in your portfolio, right? Whole media talks about how great these winners are. Not many people talk about to enjoy these wins, what you have to go through it, right? People say you got lucky, right? Oh, you got lucky. You bought Apple 10 years ago, or you bought Nvidia like 6 years ago. You got lucky. No, man, it's not luck when you see your stocks going down 60% and you're not selling it. It's not luck. It's a gut-wrenching volatility. Sometimes you may lose sleep over it. You might second guess your own actions. You might second guess the fact that Meta has got 3 billion people and the stock is trading, which is assuming that it's going to grow 2%, less than our GDP, less than the GDP of the world. How crazy is that? But when you see that the price of the stock in your portfolio is down 75%, that's the fear in which we stop thinking rationally. And I, you know what, I'm done with this. This is just gamble. You don't know how the stocks will perform, and you go out. So last 10 years, Meta has been down 75%, NVIDIA has been down 66%, and Amazon has been down 55%. Right? So I just tweeted, we don't need to keep hunting for winners. And this is what we saw every time. What's the new stock that you're investing in? What's hot in the market? Which tech is going hot? Or, there is always a stock for the season, stock for the month. What we are not focusing on is, hey, the good businesses that I bought once, how do I stay invested in it? How do I not sell my Meta because it fell 75%? Right? It fell 50%. You're like, okay, I'm done with it. Let me salvage whatever I have and hold on. Right? You sell your holdings after it fell on 50%. Of course, it went to 75%, but look at where it has come back from that drawdown, right? So it was trading at close to, I think, $80 or $90. Today, Meta is close to $600 in just 2 years. Right? If you go back and look at Meta, this was its 2 years before. We're looking at 76% drawdown over the last 10 years. This was the lowest, the worst time for Meta investors. Imagine someone buying Meta here or here, and you're like $300, and now you're staring at $75. And why? Because Zuckerberg decided that he wanted to spend $10 billion per year on Reality Labs. And of course, he had tons of cash, right? And whole media, all analysts just ignoring the fact that they still got $3 billion, 3 billion people on their platform, right? So anyway, and since then it's like ripped apart like $600, right? I didn't know it's gonna go to 600, right? But the fact that it is stocks and they have gone through these gut-wrenching volatilities. Similar case with, let's say, Apple. How many times Apple have gone like less than 30% in 10 years? If you go back and look into the history of Apple, it has fallen down more than 50% many times. So this is last 10 years, 1, 2, almost 4 times, 5 times, 30% from where it was trading. Right? And you feel like I'm foolish. I could have sold the share at $100. Now it's sitting at 70. So what happens? Next time you go to 80, you're like, okay, I'm out. And then goes to become like 100, 200, right? This is Amazon. Amazon 40, 50, what, 55% drawdown. This is Microsoft. Multiple drawdowns of more than 25%. Google, more than 30% multiple times, right? This is the NVIDIA, 50% couple of times, and then highest drawdown is 65%. Meta, right? 76% drawdown, 30% drawdown multiple times. We don't get these big winners without these drawdowns. I mean, this is what it's called. This is the cost of admission into the market. Investing is simple. You could just go and buy it. You don't have to have a complicated way to buy it. Go to a brokerage platform. You can anytime buy these stocks, right? But it's not easy to go through the whole process to enjoy these gains. So that's about right. It is simple, but it's not easy. We talk about a lot of complicated stuff. We talk about a lot of throw whatever you want to throw on a chart. Fibonacci series, Ichimoku clouds, EMAs, Golden Cross, Death Cross. There are 400 plus studies just on Think or Swim. You can go whichever way crazy you want to go, Elliott wave and all that. Try to make it as complicated as you want to. But the simple thing is, if you find a good business, just stick with it. Figure out whichever way you can stick with it. My way, which I found out, is if I can reduce my cost basis, it becomes much easier, right? If I've taken all the money out without selling any shares, then it's all the house money. Then it becomes much easier to go through these drawdowns and let the business do its thing. Sometimes businesses take time to do the stuff. It's not easy to build businesses, great businesses. If it was easy, everyone would have been just a business owner. We wouldn't have any employees. It's not easy to build business. It takes time, sometimes years, sometimes decades. So, but if you found a good business model, let's not throw away that business just because in one particular year they had a bad year, right? We don't throw that business just because one bad year, right? And figure out how do you survive in that bad year, right? When it comes to investing, it's averages are fine, but the trick is how do you survive the worst case scenarios, right? 10% growing on average looks good, but then you have to survive when the markets fall down 35% during COVID. How do you survive that? And that's more important, is to go through the worst case scenario, right? Yeah, it's just like if you're building if you have a systems, and you say, yeah, on an average, I get million visitors per hour on my website, and you sized your capacity accordingly per million. But those who are in the tech will understand you have to look at the peak load. What's the peak load which comes at any point of a time? If that is 10 million, then you need to size for 10 million. Otherwise, your website is gonna crash and you can't service anything. Same case on the portfolio, we have to strive for the worst case scenario and make sure we are able to survive that worst case scenario. If that means you shouldn't be leveraging it, yeah, don't leverage it. The reason I don't lever up too much is I want to survive the worst case scenario. Right? It looks great that if you lever up your portfolio, if the market is going in your direction, you tend to make more money. But then you are taken out the moment market turns against you, and then you miss out everything else. So that's a food for thought. I thought let's start with that because mindset is way, way, way more important than anything else when it comes to investing. I see a comment. I bought IPO of Facebook and sold for $2 per share gain. I think everyone has the story. So each one of us are students of the market. We can't be smarter than the markets. Let's be very clear. And I have my own story of how I sold Mercado Libre at like 50% gain, bought it at close to 350, 375, sold it at like 500 or 600. Good is that I didn't sell everything, and now the stock is close to $2,000. So everyone has these stories. Uh, how I did not invest in AMD when it was $2. I did not understand the chip business. Sachin says that time we didn't know about a quantitative easing. I don't know which time you're referring to, maybe 2021. But yeah, we will learn. We'll learn. I mean, it's a lifelong endeavor. So you don't have to be right today. You know, There's still a lot of life left, many years. So it's never late to learn. Okay, what else? So I just finished reading last week. I think on Saturday I told you, hey, I just got hold of this new book and I want to read this. And when we looked at the earnings chart for the previous Saturday, I'm like, hey, Monday there is no earnings, market is closed probably, so I'll spend some time on Monday reading this. None of you corrected me that Monday the market was not closed. And I thought market was closed on Monday. I didn't even open up my trading platform. I didn't even go to Bloomberg or any other financial website. I didn't even look into the Twitter's, what's happening in the market. I thought the market was closed. So Monday, got up and I thought, okay, let me just, I read the book on Sunday also. Then I said, hey, let me spend some time on the book. So I spent the time on reading through the book. It's only after around 2:30 or something. Yeah. So Ramesh, he messaged saying he's done some ASML or whatever. I'm like, is the market open? It's only after his message. I'm like, then I realized that the market was open on Monday. I thought the market was closed, but it was, I saw it around 2:30 my time. So market anyway got closed by on Monday. But the good thing is nothing happened, right? That's why I don't do zero DTE because I don't have to watch the markets. But this was funny because I didn't even realize that the market was open. But good stuff, good thing that came out of that episode is I was able to finish the book. Maybe I will summarize the findings in some session. But it's a if you're interested in like thriller movies, this is like a business thriller. This has been written by the ex-CFO of SoftBank, which is known for $100 billion vision funds, and how all the stuff that we saw in 2021 was driven by SoftBank. So after reading this book, you still realize this, it's not that the VCs are the smartest people out there. Money does strange things to people. You'll just throw away all the blind. You will put the blinders on your head, in front of your eyes. You won't think in terms of when you're analyzing a business if you have tons of money. So it's a great account of Alok's, who is a author of the book, his association with SoftBank, and how they were investing in it and what happened. So pretty interesting book. So I will maybe summarize some of the key learnings from this book. And we see this, we see this again and again, right? Probably I wasn't here in 2000, so probably the similar thing had happened in 2000 where VCs were throwing money on any kind of business plan, and then in 2020, because the financial memory is around 2 decades, we have a change in guard of 2 decades. New people come in and they have not gone through the previous crashes, and then we start the same stuff again in terms of throwing money, $100 million, $500 million on God knows what projects. So yeah, I finished this one. The new one which I started this week is going way back in the history, looking into the history of market excesses, looking into the history of great technological revolutions, and then the impact on the market. Because this is what I'm seeing right now is AI is the next great big things, just like internet was, crypto was supposed to be. And this is not the first time, right? So right now, just finished the first chapter where it was about the railways in 1850s was as impactful to the economy as what we think AI is, right? Uh, I'm of a firm believer that to understand what's going to happen in future, don't look at the charts. I want to go back and look into the history and say, how did we as an investors behave? So those are some of the stuff that we don't change. We always behave in the same way when it comes to greed, when it comes to fear. So yeah, that walk through the history of 1850s. I find that pretty interesting. Maybe a little unusual. You probably were not expecting me to, talk about a history, but I'm, pretty interested in the history of the investing. What's the name of the book? I don't have that handy, but hold on. Yeah, give me some time. Maybe I'll let you know what's name of that book is. It's something related to market crashes or technological revolutions. Yeah, it's a little longer name. Okay, so let's dive into IBM. So I'm gonna because this is our backlog from the previous week. So I want to finish that backlog before we talk about what happened this week. I don't know who had requested IBM. I forgot to note down the name. Okay, all right. Or I at least wanted to make sure that, yeah, this is the stock that you guys are interested in. Then I'll go through this. If no one is interested in IBM, then I'll skip. But okay, so Ramesh, you asked for it. So let's talk about IBM. So there is some of the information I picked from the 2023 annual report, because I don't think I ever bought IBM. I ever had IBM in my portfolio as a stock. So I never looked at as a business perspective, right? What they do. I mean, kind of having spent more than 2 decades in the tech industry. I mean, we know kind of what IBM does, but I never looked at from the eyes of as an investor, right? So here I'll give you maybe next 15, 20 minutes on what IBM does and a little bit look on the financials. Again, this is not a deep dive, which I would want to do because I'm actually not even much interested in this to move on to the second step where I want to do a deep dive. But if you are, at least next 15 minutes will give you enough information for you to figure out if you want to go deeper in this company or not. So 3 main businesses right out of their annual report on the front page. They'll say IBM. I guess this is like moving upwards and onwards, software, consulting, and infrastructure, right? So overall portfolio, we'll look into the financials later. So this is what they talk about. Their overall portfolio is infrastructure, which means your public clouds, enterprise infrastructure, edge. I don't know if there is anything on the IBM on the edge computing side, right? IoT or stuff like that. Infrastructure, they have IBM Z, which is, I guess, the latest versions of their old tech mainframes, right? Then they got their Red Hat. This is Red Hat. They bought Red Hat, I guess, maybe 2015, 16, 17. I don't recall exactly, but the whole idea was, the computing is moving towards cloud, but not everyone would want to be 100% cloud. So you still want to have, some data in the cloud, some on your own control in your servers that are controlled by you. So basically hybrid. And Red Hat is you could say a service provider, which basically help you to, deploy Linux operating system, right? So Linux is an open source. If you are a techie yourself, you can download Linux and install on your computer, on your servers, and run with it. But not every company is, as techie savvy as they would want to be. So they want to have some support on Linux, and that's where these distributors will come in. That's a business model behind any open source software. Is you become a distributor, you use that open source software, maybe modify a little bit, it again depends on the licensing stuff, and then you resell it and you sell your support services along with it. So Red Hat sells Red Hat Enterprise Linux. IBM bought it because they realize mainframes is not going to stay forever. Slowly, companies are moving towards Linux operating system, right? And now, because it's AI season, they had to plug in this AI and data platform, right? Watson X. We've been around, hearing about these tech companies. I remember hearing about Watson maybe 10, 15 years ago, even before I landed in US. I heard about IBM Watson. They were the first time then when we heard about something called artificial intelligence. That time the name was not artificial intelligence, but it's the computers who can defeat humans. Gary Kasparov, that was big blue chess. I think I was in school at that time, wherein for the first time, a computer actually defeated a grandmaster Gary Kasparov. I go way back in 1990s, I guess, late 1980s or early 1990. And we were so amazed reading through it on the newspaper. There was no internet at that point of a time. I'm like, wow, now we have a computer which actually can play chess, so-called big blue, deep blue, something. So IBM, has been on this for probably before anyone else, but they kind of frittered away their advantage. I know a few years ago, maybe a decade ago, Watson was supposed to help a lot of these pharmaceutical companies to do drug discovery and all that. Didn't pan out. And then no one was talking about AI and machine learning and anything else, with IBM in context for many years. Now the AI has become fashionable. ChatGPT has changed everyone's thinking about AI. And Watson, they're trying to revive the brand name of Watson or write on that brand name. So that here they're talking about AI and data platform using Watson. And then, of course, software and services, which is automation, security, transaction processing, basically is their mainframe. Right. So let's talk about their AI strategy, which is around, they have a venture fund now. Right. So basically, venture fund they've allocated $500 million to find some good businesses, good companies in the AI space, and basically invest in that. Right. I see it as I mean, fine, you want to have a venture fund, they generate decent amount of a cash flow. So $500 million is not going to break them. But that doesn't mean that you are guaranteed to succeed, right? Intel used to have a very famous, Intel Ventures. I mean, Google have their own venture firm. One of my friend was in Intel Ventures, but that doesn't mean your future is secure. You may get some insight into what's happening in this industry, but nothing beyond that. So their business segments. Software include everything, all the software solutions except the operating system. Now, hybrid platform and solutions, which is we talked about Red Hat, which is the business, the division that installs or provides you with Red Hat Enterprise Linux, OpenShift, which is their multi-cloud software. Then basically automating the IT operations, data and AI, nothing specific here. And of course, security, implementing a zero trust security, etc., etc. The third part of the transaction process, the software is their transaction processing, which is their on-premise workloads, right? This is a euphemism to say their old mainframe businesses, basically. So IBM operating systems like DB2, you'll be surprised, there are still many businesses, and the big businesses that have been around for decades still run on IBM mainframes. Right? And that's their cash cow. That generates a lot of cash for IBM. Because it's not easy to rip and replace the technology that has been built over decades. Right? And that's a business where we basically include IBM operating systems, the database is DB2, and WebSphere running on their own ZOS. So that's on the software side of the business. The other is on the consulting, which is where you get expensive IBM consultants to come and do maybe strategy for you, business transformation, right? And I remember during my early days when I was working with a tech consulting implementation, sorry, tech outsourcing company. So we used to have a partnership with IBM for any SAP implementation. So IBM business consultants will come, give the blueprint, right? Create a blueprint for technology implementations, which then we would use to do it, right? So that's a part of the business transformation, provide strategy, design systems, implementation on how you can better your business processes. Then comes the tech consulting. All right, I know the business blueprint. Now, how does the tech fit in it? What systems do I need to have? How to design and architect it, right? So all that is part of a tech consulting. I mean, all your like Accenture does. I mean, Accenture, Deloitte, they all do all these things. It's a similar concept of, um, and I think there are others as well when it comes to all this tech consulting, and then focusing on your application operations, how your cloud applications will be operationalized, how to make sure that they work best, either create your application, create for you, or maintenance and all that. So all that comes under part of a consulting. So this is not that they've created a product and then they're selling it and earning a license revenue. This is generally a low margin business because you have to employ consultants, you have to employ people, and you can't just copy and paste and sell people, right? When it comes to your software revenue, the marginal cost of creating one additional copy of software is zero, right? And so once you have your software ready, that's why if you look at the pure software companies, the margins are the gross margins are higher because the cost of creating the software, or in case of a SaaS, maintaining and hosting it not that much, right? So that's why investors love software companies because of the margins are good. Consulting is not that not that huge when it comes from a margin perspective. Then the third business segment that they have is infrastructure, right? Now basically providing you with multi-cloud, software as a service models. You can go and host it on IBM cloud, or they will allow you to host it on other public clouds to manage for you. So these stuff comes under their infrastructure and of course supporting it. Strangely, an annual report in the text, I found that they have another business segment called financing, even though they don't, want to or talk about it in their portfolio or in this infographic. But I did not know about it. I mean, I knew about other stuff, but they actually have a financing division which help their clients, take loans from IBM. So they basically provide financing if you want to install big IBM systems and you cost of $5 million, $10 million, or you're looking at a big business transformation project, or maybe a big migration project from your on-prem to AWS cloud, IBM will first come and do your business consulting, then they'll do your IT transformation project, run over, a few years, and that costs money. That costs millions of dollars. So IBM also has a business segment, which they reported separately, called financing. So these are the top 4 segments in which IBM largely operates. So they used to have another company for IT supported services, which I think used to be IBM Global Services. They spun it out maybe a few years ago into a separate company called Kyndryl, right? So are we not gonna talk about Kyndryl today? So this is what the remaining portion of IBM is. They're available in 175 countries. Their operations are in 175 countries and close to 282,000 employees. So it's a big employer. Now let's look at financials. Right? 2022, 2023, overall revenue is like $61 billion. So it's a It's a large cap company, even when it comes to the revenue, like $60 billion. But look at their growth. Overall percentage growth is 2.2%. At 2022 to 2023, okay, I can get maybe, customers pulled back in 2022 because 2022 was year of efficiency. Clients wanted to not spend as much as because they've already spent in 2021. A lot of tech spending happened in 2021. Maybe you can give them some benefit of doubt that you grew only 2%. But compared with other companies, this is very anemic growth. So maybe we should go beyond just 1 year and look at it, which we will do a little later. Looking at a gross profit, margin is 54%. If you're looking at a pure SaaS software companies, generally the gross margin that I want to focus on is more than 70%. Right? If a company says that we are a software company and your gross margin are less than 70%, that my antennas goes up like, what else do they have? Right? And I think in this case, for sure, their consulting business, which is generally lower margin, probably dragging some margins down. Non-operating, okay, so now they're talking about a non-GAAP. So I don't know. So gross margin 56%. Oh, yeah. Oh, they actually have a breakup of consulting gross margin 26%. Right? Yeah, so software is 80%. I didn't even read that. So software is 80% gross margin, which is what I would expect it to be if someone calls themselves software company. And the consulting is what's dragging them down to, like, their gross margin sucks. Obviously, because it's a consulting business. Software financials, where the money in software is coming from. Overall revenue of $26 billion. So out of a $60 billion, it's a $26 billion is close to $26 billion is only coming from software. $20 billion is coming from a consulting. It's like, and I guess a lot of this consulting revenue is coming from because someone has to maintain those old IBM mainframes. Our banks, our some of the utilities, they are still running. Airlines, they probably are still running a lot of their back end infrastructure, the core transactions infrastructure on IBM machines, on IBM servers. You still have to maintain it. You can't just, as long as you have it, you can build a fancy website, but that website needs the data that comes out from your transaction systems, which are still running on IBM. So I think this is, now those customers are stuck with it, and they continue to pay them. So $20 billion out of 60, almost 30% of the revenue is coming from consulting. If you go and look at software product companies, the general trend, you would want to see consulting revenue to be less than 15%. I spent more than decades on the professional services, consulting or implementation side. And when we used to run our numbers, when we used to have our okay, overall company numbers are, let's say, $100 million, that translate to $15 million for our division. And then that get distributed, maybe of 2 million, 5 million, 6 million that I need to generate, and with other folks also. And the reason why is like 85-15 is, if you're a software product company, you're valued by the street at much higher multiple if your consulting revenue is below 20% of overall. If it is more than 15-20, then you're not really a product company. Then you're just selling, seats, or you're selling bodies, right? Or you're just selling consulting services, which are generally lower margin. Okay. All right. So go back and look at, 1 year average of 3-year, 5-year, 10-year, 15-year data. Right. Overall gross margins around mid 50s again. So it's not just that, that it's happening only for 1 year, but overall their margins have been, in gross margin in 50s for last 15 years of average. Right? Before that, let's look at some of the other financial metrics. PE at 25. Yeah, if the company is growing great, this is justifiable. But forward PE 23, so it's not cheap. It's pretty expensive company looking at the growth that's been projected into and what we are paying today. Look at the PEG ratio is 4.47. Right? It means either today price is, even if you consider how much is going to grow in future, still today price is much higher. Price to sales 3, debt they have close to $60 billion of debt on their balance sheet. Overall market cap is around $214 billion. So they are able to generate.
Please explain the PEG ratio.
So PEG ratio is to be used. Okay, let's take an example of company A and company B. Okay. Company A's PE ratio is, today PE ratio is 30. Companies B PE ratio is also 30. But companies A PE ratio is 30 because it's going to grow its earnings in future, let's say at a 30%, right? But if company B PE ratio is earnings is 30 and it's gonna grow its earning in future at 10%, I would want to invest in company A, right? But not in company B. So how do I differentiate between these two? Because both of PE basically tells you what the historical number is, what's the historical earnings has been. So the PEG is price over earnings growth. So it will look at your earnings growth. In that case, for a company A, whose PE is 30, but earnings is growing at a much faster pace in future, anticipated earnings is growing at a faster pace, the PEG ratio will be lower. For company B, the PEG ratio will be higher. Now, the general investors would say, if you talk about value investing or even growth investors, PEG ratio more than 2x means you are really expensive. Like 2x, 3x is you're really expensive. Of course, you can't find great companies, growing businesses at a cheaper PE. That's not going to happen. If you only focus on PE, then you'll miss out on some of the greatest companies in the stock market. So the idea is, yeah, I'm okay to pay, but how much am I paying, right, for that growth? If you're paying like PEG ratio under 2, still okay, more than that, you have to be a little cautious. So in this case, like 4.47, right? Even though if IBM may be expected to grow, and I don't know, we look at it, today price maybe still pricing in too much, from an earnings growth perspective, still we are paying up too much. So that's what the PEG basically normalizes the two companies which have a different earnings growth. It gives you a way to measure them, with the same yardstick. That helps.
Absolutely. Thank you. Thank you. That's very
All
helpful.
righty. So $13 free cash flow, cash and cash equivalents $13 billion. So there's a healthy balance sheet, right? So $60 billion of debt doesn't really bother me because I think they got 5.96 interest coverage ratio, so they can easily pay the interest. All righty. Operating margin in the mid-teens, that sucks if you call yourself as a software company, right? And revenue growth. Okay, I was talking about 2%. Look at the last 10 year of CAGR. It's negative 5%. Compounded annual growth rate for last 10 years is negative 5%. Last 15 years is negative 3%. So this has been in a declining revenue business. Okay, that in itself may not be a reason to hate the stock. I'm just throwing a data point. EPS have been declining. Last 3 years, something had changed in IBM. And we all know what happened. They promoted Arvind Krishna, who was managing the IBM Cloud, to the CEO post. I think it happened during pandemic. I don't remember exactly what year. And of course, he probably is doing all the right things to increase the revenue, to move the company into more profitable segments, focus over there. What else? Yeah, hand some free cash flow, which is coming in because the growth. I mean, you're still just bringing in some decent amount of revenue, and you don't have a good growth revenue, so that result in a free cash flow because you don't have anything anywhere else to spend that money. So, so far that's fine. We can ignore this one. So let's look back at the valuation perspective. Oops, where do we go? So far, all I know is it's a steady Eddie business, probably in transformation phase over last 2-3 years, because it's kind of got beaten into the dust by other tech players with revenue not growing or growing at very slow pace, or rather in this case, revenue has been decreasing over the last 5-10 years. But we do see some signs of being turned around in last 2-3 years, right? Have they completely turned around the ship? I don't know. I mean, these transformations take longer. So let's look at from a valuation perspective, what's today's price? If you want to focus on the free cash flow, running your reverse discounted free cash flow, 6% growth in free cash flow is being priced into today's price. I know whenever I took the screenshot, IBM was 232. Where is IBM currently trading? Okay, 232. So maybe I did it after Friday. I updated with the latest one, right? So can it generate its free cash flow by 6% year over year for next 10 years and then grow it by 2%? I don't know. Last 5 years, CAGR has been 2% for free cash flow. Last 5 years on the revenue side has been negative growth, right? But we do know that this is a company which is in transformation phase. So what analysts are expecting that they're going to grow their revenue on an average 4% for the next 5 years. They're going to grow their earnings close to 9% for the next 5 years. Could that translate everything into free cash flow? Maybe or may not be, depending on how much investments does Arvind Krishna wants to do to basically run the business. But my perspective, I think we are pricing in too much. I mean, there is almost no margin for error if you just want to buy the stock here. It is fully, or I would say little overpriced from a free cash flow perspective. But free cash flow just tells you the numbers, right? It's not based on the future story. And now if you think that IBM can turn around and become let's talk about what's the future story of IBM could be. Big player in the cloud? Like, could they be number 5 big player in the cloud? Behind AWS, Azure. Third one is Google Cloud. Fourth one is Oracle Cloud. Can you imagine that Oracle now became number 4 player and not IBM? Who talks about IBM when it comes to the cloud deployments? Maybe number 5. I mean, I don't hear market talking about IBM for their cloud deployments. Maybe the customers who have been sitting with the mainframe, if they want to reduce the cost of running their systems, probably they are the only one who go to IBM Cloud. So the other one big opportunity is around AI. Can they now turn around the Watson, use a Watson brand name to actually generate meaningful amount of revenue from AI? Maybe. Give some benefit of doubt to Arvind Krishna, new blood, new CEO, trying to turn around the company, right? Yesterday I was listening to a podcast and I do want to get my hands on the study, which looks at many companies over past many decades, found out when the new CEO is hired, how over years the business performance has been, right? And then how the stock has reacted. So new blood trying to prove himself. In this case, Arvind Krishna is trying to prove himself, trying to get into the league of these big CEOs. Maybe he'll do better than what the old management has done. But for me right now, it seems to be that it's been fully priced in. Number two is I'm not a kind of investor who's investing in just because, yeah, you can get some nice dividend and maybe a string of free, maybe some share buybacks, which it has done. Its dividend yield is like 4%. If you're a dividend investor, maybe I think this is a company that will continue to pay dividend, but probably not grow much. It's not gonna become a next big thing. So that's what you need to think about. Right? I am not interested in this, but at least I shared with you the different viewpoints. Now you can determine, what do you want to do. I also came across one I think it was on Twitter or somebody shared on Twitter. It's on probably on Reddit, where an honest assessment from an employee, and this is what that person has to. I've been at IBM for a couple of years now, and I honestly question why we are still here, pretending that this company is gonna turn it around. Our best days are long gone, and we are witnessing a slow and painful death. Anyway, this is an internal employee or maybe a disgruntled employee, so take it with your own pinch of salt. So let's talk about cloud. IBM cloud for extremely tiny fraction. I agree, no one talks about cloud. And only because companies, okay, so this is okay. So I think this deals with my assessment that the companies that are using are the ones which are stuck with the mainframes. Red Hat, they bought it for $34 billion. Okay, because we dropped the bot so hard on the cloud, why build innovative cloud solution when we can just acquire something decent and slap our logo on it? Our hybrid cloud strategy is merging old systems with slightly newer systems. Consulting. Most of our cloud revenue comes from services, consulting, and managing cloud infrastructure, aka getting paid to help other companies figure out our legacy technology. This is why the global service is our biggest revenue stream, which is kind of not correct. Software was the biggest one. Our strategy is to sell complexity, and eventually that company spirals into integration nightmares, and then we sell our own consultants to fix it. And for my mainframes, it make billions by just keeping mainframes on life support, which is true. That's why they got a $20 billion. We charge ridiculous amount of fees for the enterprise software, and they have no choice but they have to pay up because the complexity and the cost to move off from the systems that have been built over decades is too high. And same work with the software licensing too. The companies are trapped when we charge high maintenance and support fee, and they have to shell out for upgrades and all that stuff. So it's like you have nowhere else to go, but customers who are being trapped like this will jump the ship the moment they figure out someone comes up with a clear-cut migration path, how to move them off mainframes, I guess. That's never a happy business. I don't want to invest in a business which is growing just because the customers have no other choice. That means at the first availability of choice, customers will ditch you. Again, this came from an internal employee, or maybe who knows what you read on Reddit is true or not. But the outlines probably are something which is we are aware of, right? Looking at the revenue breakup, where the revenue is coming from, looking at who talks about IBM as a cloud, no one, right? So that's on IBM. Now you do what you want to do, but I'll stay away from IBM. And I never looked at IBM before the session, so So thank you for asking to review IBM. Now, if you're interested, you want to go for, maybe I'm a dividend player. Looks like they have a free cash. I mean, they have a decent amount of revenue coming in. They can continue to pay a dividend. But overall, you need to look at total shareholder return, which means investing in today's price. That's something which you need to focus on. All right, going through some of the comments. Ramesh says, I traded Red Hat and IBM bought it. Okay, yeah, I wasn't even active. I was hired by ISSC, IBM IT Services, 1996, and at San Ramon. I think back then they had like 100,000 in the IT sector. Okay, now they have like 300, almost 300,000 people. Yahoo Financials 13.53. They may be showing trailing 12 months, etc. The numbers that I had was like, I think I had trailing 12 months as well as yearly numbers. Too much dependency on possibility of turning around an AI. There are safer options. Yeah, there are better options out there. Ramesh says, who provides the data to research analysts? No one predicted ASML loss. We will talk about ASML. So whole lot of questions. Cell complexity is true with IBM. All right, and dividend should not be reason to invest. I don't know. There are some reasons on if someone is already retired and want a consistent income stream and you don't want to sell options. Yeah, dividend could be a way of getting that. But if not, it's a double taxed. I mean, it's not an efficient way to return capital, but dividends is, I guess, is a way for someone who needs to run their household and they want to have income, right? You don't want to sell your shares and attract sell your shares and miss out on future growth. You want to invest in the dividend paying stocks. Again, you need to understand, I don't know if I'm going to cover it today or not. What level of dividend percent are you comfortable with? There was one ETF, and maybe let me see if I don't want to jump the ship if I'm going to cover it tomorrow. Sometimes focusing solely on high dividend actually can wreck your portfolio. So we'll talk about that. All right, anything else on any other question on IBM? Before we move on to the next part, which is talk about this week. What happened this week? No more questions on IBM. I'll sip some water and then. Alrighty. Let's look at the markets. SPY up more than 23%. Right. This week it hit a new all-time high at 556. Looks like market doesn't know it knows no bounds. Right. Unidirectional. This was the low in October, 409 to 586. Jesus. Great time to stay invested. Thankfully, if you didn't get scared, that's what, like, you cannot achieve these 10x benefits if you're gonna either sell it when the stock has doubled or you're gonna panic sell it because the stock has fallen down 50%. So market has rallied more than 12% just since August. Remember the August first week? We came and talked about it. That was a horrible week. Market was down 5% on the Japanese the yen carry trade when the yen carry trade blew up. And everything gets sold off. That was the time to pick some stocks, and I also picked something. My stock has nothing to do with Japanese yen. Why is that down? Because there was a fear panic, and when you are forced to sell because you were leveraged on the carry trade, which unwounded, then there is an indiscriminate selling that happens in the market. So, and the market is up 12% since then. Now, for the year, it's up almost 23%. The question that is, and we're going to look at a couple of charts, is can we get another 20% up year? We still got 2.5 months to go in this year, closer to 2.5 months, and in which we have one big wall event coming in, which is elections. Last year, 2023, market was up 26%. The question is, can you have one more year of 20% high? That'd be wonderful. Right? But it has happened only 5 times the past 75 years. So this is where 1, 2, 3, 4, 5, when it happened in more than 20%. Right? So 1950s, then 90s, once in 1970s, 1980, 1990s, strong bull run. And now we're looking at, this one, fifth one that happened in 2023 and right now 2024. But 2024 is not over yet. So don't count that. Can we get another one? I don't know. I surely would like to, but I don't control the markets. And I'm not going to invest assuming that we will get it. But, election coming up, depending on who wins in election, market could go either way. So we'll see. Vishal says, so after every 20% plus S&P, it goes in negative? No. If you look at 20% plus, you had another 1950s, you had another, 10, 11%, almost like more than 15% up here. This one was less than 10%. This one was negative. This was like after the whole the dot-com burst. Right? And of course, this was a great financial crisis. And what happened? This is our, oh no, this is 2022, which we recently went through, 18% drawdown. So I think on an average, markets were up 6% after 2 consecutive 20% up years. If you average that out. Right. But yeah, I think it's only in one case or 2 cases where we have seen the market turn negative. So how about 3 years? Is that too much to ask? Okay, 2 years. Let's talk about 3 years. Let's assume that we're not gonna go negative this year. I'm not saying. So don't go in a position or portfolio saying, hey, I think we're gonna make 20% this year. So let's bring all the cash in. I don't know what's gonna happen in next 2-3 months. But how about 3 years? Is it too much to ask? So there was one instance in 75 years where we made more than 3 years, which was during the 1975. So that may be a little more too much to ask. Right? But it is also going to depend on how the fundamentals of the business are going to be. So looked at various periods when we had these, 2 years of 2% plus market performance, and see what 2025 may be coming up, right? So I'm not going to read through, of course, not through all these numbers, but let's look at through the commentary. There were unique elements to each of these past periods, right? There's something about 1950s, which was like just after the Second World War. So we had the whole post-war expansion that happened in 1950s. And then in 1970s, there was a recovery from a stagflation. So after the crash of, I think, 1972, 73, the roaring 60s, where everything with Onyx, electronics were craze, and then the market corrected, and then there was stagflation, and then, the market fueled after the stagflation rally in mid-1970s. The rally in 1980 occurs after the inflation-driven double-dip recession. Right? This is where was it Paul Volcker, right? Non-Greenspan, Paul Volcker, right? How he killed and handled the inflation. And then the late 1990s, we all know. I mean, this is where actually have memories of these, which is the dot-com mania. And then, so current setup seems to be a little bit, is it supportive for another, good year in 2025? Let's look at GDP growth isn't as robust as it was in a previous one, because the 2 years or 20% plus gains is only close to 3%, right? In the prior one, 3.3, 3.3, 3.5, 4.7. But Fed is easing the policy now. So that you're looking at by Fed policy direction, many cases we had a tightening, right? But now Fed is supposed to ease the policy. So when a Fed's supposed to ease the policy, that generally works out better for the stock market. Third thing, corporate earnings are accelerating. Corporate earnings gonna be better as compared to, the in the previous instances, corporate earnings like 1% growth, 3%. We are looking at 14% estimated growth. So there is no guarantee that we will have 320s. But today seems to be favorable direction. So just don't sell it. Sell your portfolio saying, oh gosh, we had 26%. Add another 23% or 20%. You're not going to have it another one. There is no guarantee that you'll have the third one. But there is also no guarantee that you're not going to have a third one. All we need to look at is the numbers, right? How the economy has been doing, how the companies have been doing. And for now, there seems to be in a favorable position. That's what I wanted to share. It is an interesting one. It'll be fun if you can get the third one. All right, I got some testing. What do you want to look at? Oops. Great Powers Index 2024 projected future real growth estimate. China's 4%, Turkey 4%, India 6.3%. Changing world order. Yeah, I mean, there's nothing new if you go and read Elio's book, The Changing World Order. He's been talking about it since COVID. But here's the thing. The growth and the translation of it into the stock market performance could be different. And we've been hearing about emerging markets growth for 10, 15 years, except China. We haven't seen much growth. Of course, right now, I think a lot of focus is on India, but it's not the first time that we are hearing growth in emerging markets. So I am bullish, on, let's say, on India, or now from a stock market performance, even on China, but of course, with the disclaimer of overarching risk of a CCP, because Chinese market was available 3 weeks ago at much cheaper price than the US market. But there's nothing to say that US companies can't continue to outperform the other countries, right? Lot of the companies, the big companies in US start to derive a lot of their revenue from one of these countries. Apple has 20% revenue coming from China. Apple is now starting to sell more in India, right? So look at Starbucks, look at Nike. So a lot of companies in the US are global companies. And if some of these emerging markets continue to grow, those companies will also benefit. And final thought is, great, Mr. Dalio, how did your Bridgewater fund do? And I don't have the numbers, but I think I saw somewhere the last 3, 4, 5 years, it has severely underperformed.
Right.
Right. Bridgewater is one of the largest, if not one of the largest, it is the one of the largest, if not the largest hedge fund in the world. Now let's look for it. I think somewhere I saw that the performance was horrible. Bridgewater, Water Fund performance 2023, right? 2024 is still not out. Okay. I think maybe I saw it on Twitter, but I don't know if they have a chart or not. So this one says flagship fund 7.5%, down 7.6% 2023. Dude, S&P was up 26%. There's like 33% of differential.
Yeah.
I'll hear all what you have to say, but I have to make my own judgment. Right? There's a saying, right? The economists would be billionaire, you know, if everything what they think, the market performed in that way, but they are not. So make your own decision, but I don't think I'm gonna sell off and move everything to emerging market. But does that mean you shouldn't have any exposure? No. Last week, was it you, Aditya, who asked me what's my China percentage? So I actually spent some time this week to look at what's my overall China exposure. And it is what I supposed to be. It is like on the current value perspective, it is like 4% of overall portfolio.
Right.
So my
Right.
risk is contained, right?
Sure. Yeah. No, that makes sense. I was just comparing. I think this was more than anything a trigger for me. I was just comparing the S&P 500 performance versus like the Nifty 50 performance over the last 10 years. And I mean, the performance has been promising.
Nifty 50 has done better. I think the only emerging market that has done better than US in the last 10 years, not last 1-2 years. I think Turkey has done, it was the best last year. I think
Right.
this year maybe Pakistan or some other is best. But if you look at last 10 years, you're right. India's Nifty 50 has outperformed. You're
Yeah.
right in that sense.
Yeah.
The question is it continue going to outperform? Because it is right now also it is more expensive than S&P 500.
Right.
All right, let's look at the stock market performance in the years following consecutive 20% plus annual gains. I think except the 1977, there was a question, right? After 2 years of performance, is market declines? No. On all other cases, it had performed, it was up after a year, right? 256, I guess, is number of trading days. So it was still up. So we can't say that market is up 20% twice. So, it means it's going to correct itself. And this is one mistake that during my initial days of investing, I also did. I thought the price is mean reverting, right? Oh, it has gone 20% up. Now it should come back to its mean. It took me years to understand price is not mean reverting. Maybe in a short term, right? But volatility is what is mean reverting. Market can't stay in the heightened sense of volatility for a longer period of time. And that is why I love the whole, concept around selling options, because I know one thing which is mean reverting in the markets is volatility. Stock price, probably not. I mean, we have seen some of the stocks over longer term just going in the right direction. All the max summons we look at, it's not mean reverting. But vol is. Sachin says the fund is a fantastic book. Yeah, I have it with me. I've not read it. And I think it doesn't paint. Did Bridgewater or Ray Dalio suit the publishers or the writer? Because I think it doesn't paint Ray Dalio in a good light or something. I mean, I heard about this book when the book came out, and I think it kind of you think that Ray Dalio is, I mean, it's their own employees have a different view and different feedback about Ray Dalio as you may have looking from outside in. So I think then there was some discussions that the lawyers are talking to each other because he wasn't happy with how he was portrayed in the book. I haven't read the book though. All right, so market 1 week performance, nothing to complain about. Not that 1 week performance matter a lot, but let's look at what this count. What happened to my TSM? Okay, I don't see any other. Is my voice okay? Am I cracking, breaking?
It's all good. I can
It's
hear
all
you.
good. So it's a ThinkOrSwim which is maybe gone under maintenance. Who knows? Anyway, so I just wanted to. I want to see if we can pull up 1 week. In any case, let's look at the other market. Crypto market has been on fire. Last week, Bitcoin was up 9.1% as of yesterday night. But this market trades 24/7, so things could have changed. Let's look at what the crypto market has done. Yeah, not too different. You know, more Bitcoin, the flagship is more than 68K. Ether is trading at 2.6K, 2600. So again, I think that the prediction market, poly market is showing Trump winning 60% probability and Kamala is 40%, depending on which social media or channel you go to. The numbers are all over the place. But I think market is pricing in that maybe Trump is gonna come in, right? And that's why now the crypto is kind of a ripping because he is supposed to be favorable for the crypto industry. You never know. It's all based on, we'll figure out later only after once they get elected what the politicians gonna do. Just like now in last 2 weeks, Kamala has turned little positive around crypto, right? So it's right now it's all election tactics. Try to get as many votes as possible, and we're seeing crypto, Bitcoin ripping higher. So other thing is I think there's another from SEC approved another set of options on Bitcoin spot ETFs. I've been waiting for it so that we can start hedging the positions and all that stuff. I don't know when it'll start to trade because this being a little bit of this is considered as a commodity. There are more than one government agencies involved. So I guess CFTC will also have to approve it. But SEC was the toughest regulator. So we are through the SEC. If not end of this year, maybe by early next year, we should see options being traded on all like 7 or 10, whatever the Bitcoin ETFs that we have, right? And then we can start selling puts and doing cover calls against those. So that's on crypto. Nothing much. I see. I think it's and seasonally in crypto bros we'll call it Uptober because seasonally second half of October has been good from a historic perspective for Bitcoin. So that's why we call it as Uptober, right? So we are in a Uptober mode. Whether it's gonna go to whether it's gonna go to its previous all-time high, which was like 73K, I guess. When we had it, 73K was at the start of the year when the ETFs were approved, right? But 71. Yeah, 73, close to 73K. It has gone close to 68K. I think it's been up a couple of times. It had crossed 70K, but we'll see. And if you try to go onto social media or to these VCs and try to look at what their projections are, you could go crazy on this one. The projections are all over the place, depending on the time. I've seen numbers to $1 million by whatever, 2030 to maybe 100K by end of this year and 200K by end of next year. Don't believe any one of those. We never know what's gonna happen. So position sizing is very, very important when you're dealing with crypto. It is yet to prove. I mean, I think Bitcoin has kind of proved because now we got a black rock in it. Larry Fink is not gonna let Bitcoin fail, but that doesn't mean it's gonna go to 100K, right? So don't invest thinking that, yeah, I think it's gonna go to 100K. It doesn't generate any earnings. It's like a gold. It's run on what other people think it is worth. There is no other use case for Bitcoin right now. It's just the use case of gold, store of value. So you can't really do your how much earnings is gonna get me, how much free cash flow is gonna get me. There is no. All right. The oh, what happened? Okay, so it's still not working. I think I had a chart, but probably I forgot to put in. But I noticed that my silver position was up. I mean, what the heck happened to SLV? So let's go to SLV. Anyone tracks this very closely? I mean, I'm not a big on the commodity side, but why was this up 6% on Friday? Gold wasn't. So if I look at a GLD, it wasn't. It was like up only what, a percent on Friday. But silver was up 6%. I only noticed it, I think I saw something on tweet that what's happening with silver. I'm like, what? Did something change on silver? Then I realized that it was up 6%. What the heck happened? In my experience in dealing with silver, I have seen that it makes parabolic moves. It makes moves big and fast, right? So look at SLV. That's my vehicle for any silver exposure. It is in 2020, it was like 24, and now it's like going back to 2013, almost 11-year high. What is happening on silver? Anyone have any thoughts on silver? I'm no idea. I mean, I don't track silver. I mean, I just hold some position because I have some little bit of a gold, little bit of silver. So, okay. The Ramesh is saying switching from gold. I don't know. Silver has some industrial usage, but I don't think that suddenly we realized on Friday that XYZ company needs. Okay, let's search for it. Why silver went up on previous Friday. Silver price is today. Fridays. Oh, this all are very old. Okay, I don't think there's a specific one. Anyway, not too much bothered about it. It's not that I'm short on silver, so I'm long on silver, so that's fine. But I would have been better if I'd known why the heck it has gone up. 6%. I mean, 1%, 2%, 3%, it's fine. 6%, I have no idea. All right, looking at the overall sector perspective, pretty decent run, right? S&P up 23%, information tech is 33%. The dark horse, things that you've never seen in decades, utilities up 30%, like 29.27%, all thanks to tech companies that are now hungry for power, right? And looking at the fear and greed index, previous week we were at greed, now it moved into extreme greed. So staying cautious, not mean that I'm gonna sell off everything, but historically I've seen when there's a lot of greed built into the market, short term you see, market has a tendency to remind people that you're not the smartest ones, right? So I'm being cautious, maintaining my deltas appropriately, and I'm okay to have a lower delta right now. So this week, whatever, S&P has gone, whatever percent, I wasn't up that much percent. Not that this week matters, but I want to be little cautious when there's a greed in the market, and hold the cash on the side to buy more when the opportunities will present. So what did I do? Portfolio updates. Again, not a recommendation, but since we talk about stocks, I do want to be transparent in terms of my activities. So I bought ASML. That was an opportunistic buy, because we will see what happened with ASML. And then I had a call spreads, right? As part of my regular cost reduction stuff, I had a call spread on trade desk, JD.com. I don't think call spread. I think just had a covered call. So none of them were like naked calls. All were either call spread cover. All of them were covered. So I sold some of these stocks. I still hold all these stocks in my portfolio, but I didn't want to defend it, because right now I'm seeing greed in the market. So if someone wants to take away my shares, fine, take it away. I still hold the minimum portion that I want to hold in my portfolio. Yeah. Any questions on any one of these?
Vivek, I noticed, well, you know this. Why is the and US stock market so overpriced?
Is the US stock market overpriced right
Well,
now?
I mean, yeah, you look at the P ratios of everything, it's really
Yeah, so
kind of high. Like back in the day, I think maybe 30 years ago, the average was 13. Now it's something like 17 or something.
let's look at Schiller P 29. We're looking at a Schiller P at 29. Yeah,
It's ridiculous.
so here's the difference. The type of companies that we have, and I'm not trying to defend it. I think the market is higher. And I thought the market is higher in the mid of the year. You've been listening to me, right? So like
Yeah.
this continues to defy me. Right? I'm not smarter than market. Look at the type of of course, there is an AI component, which is like euphoria in the market. But look at the type of the companies that we have now. I think it is ridiculous to compare it with history because the composition of the index has changed. Going back in 1970s, 80s, we had a big conglomerate like DuPonts of the world, IBMs of the world, some coal companies, some energy companies, financial companies constituting a big part of our S&P 500, right? Top 10 top 10 market cap. What's their earning quality? They were very low margin businesses, right? Not as when compared to what the quality of the businesses that we have in S&P right now, the top ones. And that's why the top ones are driving most of the market because they are also high quality businesses. If you look at the top 10, etc., I think the PE probably is like 35 plus. Is that justified? No. But can I give a reason why it's trading at 35 and may not be extremely expensive? Yeah, because if companies like Nvidia and companies like Meta can continue to grow their earnings 30% year over year, then they kind of deserve that valuation. Right? So I think to me, it looks like after every decade or 2 decades, we should have moved up what we as an investor consider as an average valuation, right? Now, if I look at saying, hey, the average PE should be near 20, then I'll never be able to invest in the market for the last 10 years, 15 years, because I never had that. Because the type of companies have changed. The type of companies that are now constituting a bigger part of index are much better businesses from a quality of the business perspective. Forget about the stock price, quality of business perspective. Their profit margins, their return on invested capital is much better.
Like for instance, you just bought ASML. I mean, ASML 3 years ago was richly priced. So why did you suddenly buy it? now
I bought
rather
it.
than before.
I've been buying ASML for some time. This week
Oh,
I also added to my position. It's not my first position, right? You you look at end of a month when I share my portfolio, ASML has been in my portfolio for at least 2 years. So it's not my first buy on ASML.
okay, thank you.
Okay. All right. So since we talked about ASML, let's perfect segue into get into ASML. What happened? Okay, this is not working. Let's minimize it. So before that, let's set the ground for talk about ASML. And it's not going to be a good picture on ASML. Forget about one day. This is not going to be a good picture, right? On October 15th, so they reported their earnings. There's a mystery around that as well, right? And then the stock was down like 16% immediately after that, and then further fell down. I think from here close to 870, it was like 682, right? Near the bottom, 685, 680, something like that. So pretty substantial fall, maybe 20% fall. So let's look at what happened with ASML. Let's bring out the ASML earnings document. Where's my earnings? See, I've been on ASML, opened a starter position in 2020, $370 was my first. Probably I would have bought 1 or 2 shares so that it stays on my radar. That was my first buy on ASML. Okay. All right, so let's look at the headline numbers. All right. Not bad. Revenue was up 11%. And these are all euro numbers to 7.4 billion euros. Gross profit up 10%. Tracking the revenue. Gross margin slightly down. Operating income is up 12% year over year. When, again, in line with the revenue. Net income is up 10%. So your revenue up 11%, everything falling down to the lower levels, to operating income, to your net income. This means this business doesn't have any gotchas that you need to worry about. You increase the revenue, everything else is in line. Right? So EPS is up 10%. So there is nothing wrong with the current quarter result. What spooked the markets that it punished like down 16%? The bookings they reported was $2.6 billion, which is higher year over year. Bookings in Q3 of 2023 was less than 2.6. So booking was higher, but Street had a different expectation. Right? So before that, there was other thing that happened with ASML was they were supposed to release the results on, in after market on 15th. And then the stock fell down during the trading time on 15th. Oh, what the heck happened? And then suddenly I'm seeing on Twitter, seeing ASML's bookings shocked the market because bookings came out at $2.6 billion. Analysts were expecting $5.6 billion of bookings. So the company's bookings number were like less than 50% of what analysts were expecting. And that spooked the whole, of course, ASML, but that spooked the rest of the semi companies also. NVIDIA was down like 5%, 6% on that news. TSMC was down. I guess every semiconductor company was down. And they were concerned, hey, how did you report the numbers now? So that number got leaked out. Again, end of the day, I think the CEO came and apologized during the conference call. They say it's a human error. Someone in their investor relation department probably gonna get fired on that, but I don't know who, intern, etc. But the number got leaked out during the market hours, and then the stock fell. Looking at the capital allocation, they're gonna pay a dividend of 1.52 euro per share, and they've been a consistent dividend payer. right? No shares were repurchased, which is fine because the share prices are already high. 800 has been trading between over the last quarter, if you look at, right, which is after June and July, between 800, close to between 700 and 800. So yeah, if they didn't buy any shares, I think that's fine. Business metrics, let's look at this. So ASML, if you know, ASML creates the machines that is used by the chip manufacturers to basically manufacture the chips, right? And if you know, we can't live without chips. And there is one machine that required for all the high-end chips, like 7 nanometers and below, 5 nanometer, 3 nanometers, and now they're talking about 1 nanometer. ASML is the only company that delivers that machine. That is called EUV lithography machine. So I do want to track how much of the revenue are they generating from their EUV, because there is no competition for this type of a machine. They also have other revenue stream like DUV, which is called deep ultraviolet, but then there are other companies which also have those. In EUV, there's almost no competition. China sales, look at the last 2 quarters, China sales have been 50%. Right? And now looking at there could be one reason why the bookings are down, because maybe Chinese customers they have already, ordered a lot earlier, and now maybe they're going slow on it, or they may be able to waiting, watching on this whole geopolitical, sanctions against China, that you can't supply this machine and that machines. 11 EUVs were sold, just 11 machines in Q3, which is fine because each machine cost more than $350 million. Like the cost of one machine is $350 million plus, 350 million euro plus. And it's shipped in like 2 or 3 jumbo jet planes. It's a huge machines. Right now, this is what spooked the markets. Booking fell down from 5.7 billion euros to 2.6 billion euros, right? Overall guidance, I think this was all in line with what they had already told what's going to happen in 2024. So there is no surprise when it comes to 2024. They've been talking about that 2024 is a year of consolidation. We're not going to grow in 2024. Our growth will be in 2025. This is what they maintain in all the last quarters. No change in that. In 2024, what changed was 2025. They changed the 2025 kind of a guidance. So in the investor day last year in November 2023, they maintained that in 2025, our revenue will be between 30 billion to 40 billion euro, means your midpoint is going to be $35 billion. Now in this quarter, they came and told, we want to revise our 2025. I think our revenue will be between 30 to 35 billion dollar. Means your midpoint is going to be $32.5 billion. So this is less than what you had provided us guidance earlier. So this spooked the markets. Not only your bookings is down, but looks like your revenue for 2025 is also going to be lower than what you were expecting, and the shares sold off. Overall trends, if I just ignore this quarter, or they've done pretty nice. At 30, look at 3-year CAGR, I don't see anything which is too much need to worry about it, right? So what happened here? Lower booking, not a great guidance, that spooked the markets. Market thinking is the AI play overdone? Are we done with AI? That's one fear that everyone had. But I'll listen to the earnings call. The slowness is not in the AI area. AI area, from their perspective, still has a robust orders. It's the non-AI area. What they are seeing is a slowness in auto sector and on the smartphone sector. which looking at what's happening in China when the consumer economy hasn't got back, and that's why China government is trying to do some stimulus, etc. Because Chinese consumers are still not spending. They're still little constrained. So the companies in China, I guess that's one reason why they may be seeing slowness. And like I said, China accounted for close to 50%. Maybe they're pricing in some geopolitical more restrictions on export, right?
Can I add something?
Sorry?
Can I add something? My friend emigrated. He's selling his house for what it was worth 10 years ago. He lives in Shanghai, so it should go up, right? But he's selling the house at 30,000 RMB per square meter, same as 10 years ago.
Yeah,
And
the house,
real crisis.
yeah, so there's a crisis in China. Right?
So, yeah, because a year ago when he was living in Shanghai, he was saying everything is fine. But my other friend said differently. But so now he's in Canada. He says it's really bad. And he says the real estate crisis happened a month ago, not 2 years ago, 3 years ago. So it's kind of interesting.
No, yeah, so I think the crisis has been happening for 2, 3 years ago, where we see all the property market issues. But hold on your thoughts onto this. Let me just finish these earnings first. Okay. So so this is the reason for the lower guidance. Number one, the customer already had inventory because a lot of especially the Chinese customers, they were afraid of more restrictions. So in previous quarters, they already had ordered more than what they needed. Now they don't have to order. I mean, they kind of a front loaded their orders. So they say now they just already have the inventory of the machines. They're just using it. Two foundry customers have pushed out their plans, and we know which those two are. I mean, obviously they won't take the names, but we know one is Intel. Another one I think is Samsung, because Samsung having its own challenges. So my guess is these two customers, Intel and Samsung. Intel has already the fab that they were to do in Germany. I think they canceled it. So that's happening. And the third is recovery in non-AI segment, mobile, PC, and auto is not as quick as what they were expecting. So this is the reason why they gave the lower guidance, right? What else? I think that was the main stuff. Number two, in management, I found when I went through the earnings call that management is more conservative in providing the guidance in two ways. Number one, they've already included the impact of additional export controls, but it's not in place yet. And remember, we have election coming in. Things could change. And if we do not enforce additional export controls, that's going to be a positive for ASML. Number two is, because let's say even if they put additional export controls and then the Chinese manufacturers can't manufacture those chips, maybe their competitors will come and take away the market share from China. So the dynamics of the market share will change. Whoever is producing those chips will still need ASML machines. So that also has not been accounted for or included in the guidance that they provided. So I feel that the booking guidance that they provided is pretty conservative, right? And when the stock fell down 16-17%, I thought maybe, it's not a bad price to own it. I mean, I had my price target close to 730, and I think eventually I bought at 730. It fell down further down to 680. That's okay. You can never perfectly time the bottom. But I'm like, long term, this is still a good story. So if we really look at a long term, even when AI is there or not there, I mean, it's a good business. It's a quality business. Returning 20% return on invested capital for 15 years of average, right? When it comes to AI, they are in like high 40s. So I'm like, maybe let's pick a few shares when the market presented the opportunity, and shares were down 16%. So that's ASML. Could there be short-term tail, because this whole uncertainty around this geopolitical stuff, it may stay a little more volatile than what we are used to. But I think I also looked at some of the data. Forget AI, right? Let's go back to 2021, right? There was no AI, no ChatGPT in 2021. And then let's go back to the history from 2021 and say, how are they done in terms of their margins? How are they done in terms of their returning on invested capital, and revenue growth and all that. So time tracking, going back to 2021 and then looking into the past when there was no tailwind from AI, they're still done okay. Still done better in terms of the returns, not the stock, but from a business side. So I'm like, I think I'll still hold it, even if the AI story cools down a bit. One thing that we know is we're gonna get faster and faster chips, right? So that's the reason why I bought a little bit of ASML.
Do you know what's the approximate lifetime of these 350 million machines?
Good question. I don't know, but they do have a business. I mean, they are already came up with the new machines called high NA, and which are going to replace. And what they told is all the customers that currently have their EUV machines are now testing, using the test results from their high NA machines, which I think is Intel is right now got the machine, and then running manufacturing the wafers and testing it. And what they told us, each one of our EUV customer is interested in their high NA machines, right? So because my assumption was if a customer is spending $350 million, they would want to use it for next 10, 15, 20 years.
Yeah.
Right. So that, you're not going to go and buy $300 million stuff every year, right?
Yeah.
So I guess that will still be there, but there are customers those EUV customers are also looking at the newer machines that are coming up, because if you look, these companies are setting up fabs, right? Intel is setting up fabs in US, TSMC is setting up fabs in US, in Japan, in Germany. They also talked about, I think, so I think I took a note of who are their EUV customers. There's somewhere I noted it down. Hold on. Not here. 5 main customers: Intel, Samsung, TSMC, Hynix, and Micron. Right. And I know for all these, at least 2, Intel and TSMC, they are setting up fabs. So the demand is there. Number 2, they also own, what's they call it, install base management. I didn't go through that, but they also gave a breakup of what's income is coming from their install base management, which is like supporting the existing installation which are already there, like software and support. So that business is bringing in close to 2 billion, 25%. Looks like 25% of the revenue is coming from support services for the existing installations. Cool. All right, the second one, TSMC, which is again a company that actually manufacture the chips. I started initial position in Feb 21, 135, and after that it has gone multiple places. So let's look at TSM. Same stuff. It's a company that makes chips, and after announcing result, it was like up 12, 13%. Right? So what gives? Both are companies that are big companies in the supply chain of chip manufacturing. Why is one down 17%, another one is up like 12%? We're gonna look at that. Let's look at last 5 years. 2021. Yeah, you go through the drawdown of from 135, where I had my initial buy, to when it was down to 60, like cut in half. We talked about Max Evans. There are other stocks that have become winner, but you have to go through this whole period wherein you just have to watch the business, right? What the heck are they doing? So I've been bullish always. I don't think I had ever where I said I'm not bullish, irrespective of whether the stock was at 60 or 80 or whatever 130, because the business was still performing. Okay, so let's talk about TSMC. Everything is good when it comes to the numbers. Revenue up almost 39% year over year. And these are numbers in what do you call it? New Taiwanese dollars, right? You'll get shocked. So $75 billion new Taiwanese, 759 billion new Taiwanese dollar. Ignore the numbers, just look at the percent, because we convert to dollar, almost probably will come out to similar ones. Revenue up 39%, gross profit up 48%, operating income is up 58%. So this is what I like it. This is what's called operating leverage. When your operating income starts to grow at a faster pace of revenue, I don't have to always have to spend a lot more on growing revenue and can still generate more income, because now I'm achieving operating leverage. Almost 58% operating income, net income of 54%, cash flow of 33%. I mean, there is nothing not to like. Beat on revenue, beat on EPS. They also give cash dividend, right? They didn't buy any shares. Let's look at this. So they do a good job of breaking into, which business segments they sell most into. So high performance computing, these are our hyperscalers, Google, Amazon of the world. 51% revenue comes from them. Smartphone, 34%. And these will be companies like Apple, Samsung probably does its own. Yeah, this is probably going to be Apple's and other manufacturers, other phone manufacturers. I don't know where they classify NVIDIA, maybe under HPC. But smartphone is now 31/3 of the revenue. High performance computing cloud is like half of the revenue. Now, from a tech perspective, this is where the stuff becomes interesting, is the chip size, right? The smaller the chip size, more complicated it is to make. And in TSMC, anything below 7 nanometer, 753, is considered as advanced chips. This is where you will need that ASML machine to make these chips. And TSMC derives, let's sum it up, 32 plus 20, 52 plus 1769. Almost 70% of the revenue come from highly advanced chips. And these are not easy to make. They have perfected the art of making these over decades, right? I guess the process has got 1,000 steps in it. You just can't rip and replace, in the ecosystem. So I do want to, keep an eye on what's happening with their most advanced chips, most complicated chips, like 3 nanometer chips, is now become 20% of the revenue. So this is a big mode that they have. Guidance. So they actually upped their guidance. So the guidance provided earlier, they actually increased their guidance because they saw the business performing really well. So now what gives? On one side, ASML is saying smartphone side, our bookings were not that great on the smartphone side, and TSMC has a great quarter. The reason is yes, so the bigger customer of TSM, ASML is like TSMCs and the Samsungs of the world, right? So when they order, TSMC probably will get the machines a year later. So this takes time to actually make the machines, right? So they are looking at what might happen in a year or two later, and based on that, they're ordering. So even though this year TSMC has got, you know, good revenue, everything looks good, maybe they're looking at maybe in the future, 2 years down the line, we may not have a similar demand or on smartphone on the PC side, maybe because all the AI PCs that currently all the manufacturers are making, in 2 years later, the growth of the demand won't be that much. Again, we don't know, but so far so good. TSMC had a great quarter. I think this is still a good company to own, given the space position that it has in this space. So I had a call spread on it. I sold some shares because, the stock was up wherever it was. And if it falls down again, I'll buy it. If not, I'm going to enjoy the ride on the shares that I still own in my portfolio. So the chip sector was something that I only started to look at it during pandemic, but I'm happy that started to focus on this one. It's been one of a good addition to the portfolio. I never looked into any chip or networking company before that in my career, but there is always there is no wrong time to learn new things. So for me, it was the chips. All right. Let's look at what the new earnings, and then we'll stop there. We'll ignore the rest of the stuff. We're already 12:17. Anticipated earnings next week. What I'm looking on is, of course, the big one is Tesla. Just because, it generates a lot of heat in the market, a lot of discussions in the market when it comes to Tesla. So, and also I'm a Tesla shareholder. What else is coming up? I'll see what GM has to say, because they I don't know, about the last quarter or somewhere there is a news there. Of course, both GM for their dialing down on their EV. GM in fact went to the extent of saying not gonna continue our Ultium the battery platform. So want to see what GM wants to focus on. I am a shareholder of GM. What else? I think I had one more. Boeing. Yeah, less we talk about Boeing, better it is. It's been hitting new 52-week low every week. So, yeah, these are the ones that I will look into it. Service now looks interesting. This is the company that I always feel I missed. I don't have it in, and it's been doing wonderful. But we'll see. You can't get all the companies, right? And I want to only focus on the ones which I can continuously follow up. But if service now presents good opportunity, maybe we will. Thoughts on UNH? UNH is what? United Health, right? I don't own this. I have not looked into this. Is this the one that's dependent on the space is so regulated? Did this get punished, or was the other one that got punished? Oops. Okay, so this is the one that got punished. So I don't own these ones because they are heavily dependent on Medicare, and I don't understand that space. Medicare, Medicaid, how the insurance stuff will work out. So what I heard was, I don't know, maybe I was looking into something else. But if you want to look at in terms of what's, U and H, let's look at some margins and see that as a business side. 14% growth, but when it's a $300 billion revenue, I want to see how that growth translate into a lower levels. Let's look at the other margins. EPS growing at 12%. What are their margins? 25% or bad, 8% operating margins, 6% profit margins, 7% free cash flow. I guess they also, so they are generating some 7% free cash flow. So this is a good free cash flow company. So free cash flow, almost 26 billion free cash flow. Trailing 12 months is only, maybe this is not updated. So it does have a good free cash flow, and I guess it also pays dividend. What's the dividend yield? Let's go back to ratios and look at dividend yield. The yield is okay. So right now the yield is not that, but not that great from a dividend perspective, but it's got decent free cash flow yield, 1.2% dividend yield. They also kind of buy back some of the shares, but yeah, it could be a dividend or steady income play. It's like a $300 billion, $500 billion company, not going to disappear. But I just don't understand the whole dynamics of how the government, I don't like a companies wherein a government can come and suddenly, turn around your business model. So if you understand the space, sure, I think you can get it at a cheaper than where it was trading earlier, but I am not touching this, assuming that, hey, now it is available at a cheaper price. It may not be it could be or could not be a falling knife. You will only get to know in hindsight. But if you understand the business, from 600 to, okay, it wasn't that bad. It's like down less than 10%. You may look into this. All right. What else? We can hang around for another 5-6 minutes till 12:30. Anything else you want to look at? All right, looks like all good.
I have one question related to, I think you call it portfolio weighted beta and delta. So that's very specific to options. At some point, I just wanted to look at some examples of it. I was just struggling to apply it to my portfolio. I know it's a very involved topic and it's very specific to options. So, yeah.
So at a portfolio level, you're not talking about an individual ticker level, right? You're asking for at a portfolio level.
Yeah.
Okay. So first of all, what platform do you use?
Think of them.
Okay. So Thinkorswim does show you what's your total delta theta of an overall portfolio is. You know where to look at it?
Yes.
Okay.
Yeah. So I see delta and gamma. And then,
Okay.
so basically, are you literally just saying when I check that beta weighting checkbox and I look at the summed up delta numbers, I wasn't sure where to see the beta and how
Okay, this is
does it work with the
interesting stuff.
delta.
So when you check that box and say beta weight, the box is to beta weight your portfolio. right?
Yeah.
And then you tell what you want to beta weight it against, right? That
Yeah.
will depend on what kind of a stocks that you have in portfolio, right? What's your what index does your portfolio closely resemble? Is it SPY? Do you want to beta weight it against? Is it QQQ? If you are a smaller companies, small caps or medium caps, do you want to beta weight it against IWM?
Yeah.
That's what you have to define. So I generally try to beta weight it against SPY because I hold, multiple different sectors. So
Yeah.
once you put that ticker in, then whatever the okay says thinkorswim is under maintenance. I'm trying to reload. So once you put that ticker in terms of how you want to beta weight it, it will show you the number at the end.
Yeah. So for example, if it shows me like a delta of 36.72, that's the total delta it shows.
Okay. So now the
SPY.
interpretation of that, okay, this is not working. So interpretation of that is, and again, this is not science, it doesn't work 1:1, but interpretation of that is if the SPY or whatever ticker you have used to beta weight your portfolio, if that ticker moves $1 up, your portfolio is going to move up close to $36.
Right.
Okay, so that's what the interpretation is. It's not going to happen that the SPY moves up and your portfolio has actually moved to 30, right? But looking at last I don't know how long they go back to look at a beta value, probably 5 year. Looking at how each individual ticker in a portfolio has behaved in correlation with SPY, right? You can draw those mathematical correlation coefficients. That's where the beta value comes from. But let's say if SPY is up 2% because just one stock Nvidia is up 10% and SPY is up 2% because of it, and you don't hold Nvidia in your portfolio, you may not go up. So there are a little bit of nuances, but it gives you an idea of, I don't focus on an absolute value, but I focus on, hey, if the stock market, if SPY was at 540 and I had a deltas of portfolio beta weighted delta of 300, let's say, and then now today the SPY is at 590, and if I'm not too overly bullish, then I should have a less portfolio beta weighted delta as compared to what I had earlier. That's how I use it in decision making. And when I say I want to make sure my deltas are okay, and then I look at my portfolio and I say, okay, I think the deltas are now more than 500. That means my portfolio is bullish, more bullish than what it was in July. Am I more bullish about it, about the market? If I am, then that's fine. But if I'm not, then I have to adjust my portfolio to reflect my own thesis. And then I'll go and let's say change the deltas. I've done it in both cases. Sometimes markets rip higher, and then because I have options where we have sold call, my delta drops. And I've seen like sometimes it becomes delta 50. I'm like, oh, no, I need to add a little more bullish trades on it. Then I'll go and do the bullish trades to add delta. But that's how the interpretation will work out.
Right. Right. Okay. And to summarize that, so if the market went up, you said by $1, my portfolio will go up by about 36 based on that previous number. If it goes down by $1, portfolio would also go down by
Yes.
36.
Yes.
That's the correlation?
So that's how the interpretation works out. Like I said,
That's the delta.
it,
Yeah. That's by delta by definition, right?
Correct. And now Nvidia is a new phenomenon, right? They don't have like 5 year history of correlation was not there. So it could come and screw it up, which I've seen sometimes, hey, why is like market is down because on that whole ASML stuff,
Yeah.
when that went down, I wasn't hurt that much because I had like my deltas were not that high and I had my calls which I've sold became profitable. So because it's like Nvidia's correlation over the last in the recent period is very different from what was last 5 years. So that might screw up a bit, but that's what you're saying is that's the right way to interpret it.
Right. Right. And then when basically you are risk balancing your entire portfolio, are you looking to stay within a certain range? Like which way are you sort of course correcting?
So so I am looking to stay in the range, not like say not on the absolute number perspective, because that just depends on what's the size of our portfolio, right? I'll give you, let's say if I'll give you any absolute number saying 50
Sure.
or 100, that doesn't mean anything because that's if my portfolio is much bigger, then I'll have a bigger uh, number to start with, right? But what I'm looking for to do is, am I more bullish on the market right now than what it was, I was, let's say 6 months ago? And then
Okay.
is my portfolio beta weighted delta is more than what I was like just 6 months ago? So
Okay.
I kind of have a range when I'm looking at is, which I say, and let me tell you, in the last, after August, I become a little more bullish than what I was in, let's say, in July, after between June and July. Right. So I thought, I think I need to now start with a little more positive deltas because markets are climbing all walls of worry. Right.
Mm. Yeah.
So like it's just defying me.
Yeah.
So then I decided maybe I think I should raise up another 50 or 100 deltas as my baseline.
Right.
And and then I change my trades accordingly.
Thank you. Thank you. So that makes sense. So you use it more as a sentiment check, maybe in line with the greed and fear index or something, just to see
Yeah.
of
So for example, today we looked at fear and greed is in extreme greed, right?
yeah.
So I am not gonna go and do a bullish trade right now, right? Because I'm thinking I want to be cautious, then I shouldn't be selling a put against SPY. If I want to generate a cash by selling option, I shouldn't be selling put because that means it's a bullish trade. I want to be cautious. Maybe I'll do a delta neutral trade. I'll do an iron condor at a delta neutral.
Yeah.
Or maybe I'll sell a call to generate a premium because that is little bearish trade or cautious trade. Right? So then I'm okay, I'm not going to add little more delta because I'm a little more cautious
Yeah.
because right now the market is extremely. So that's how you use it.
Thank you. Thank you. That's very helpful. Thank you.
Cool. Alrighty, I think that's all the time I have. I saw two tickers, ACN. So let's look at ACN next week. What is CI? ACN is, I think, Accenture. What is CI? Cigna. What's wrong with you guys? Everyone is on healthcare. I mean, nothing wrong, but I am not a big healthcare investor. But Cigna is okay. So let's look at this ACN and CI next week. Let me take note of that. Cool. All right, guys. Thank you very much. Great to have you here. Those who joined here for the first time, I hope you are able to learn something new and be able to use it to manage your own portfolio. It doesn't matter how big or small the portfolio is, there is always everyone starts with the baby steps, and we just need to make sure we learn it the right way and with the right mindset. I think that's way more important than the right stock. So thank you for joining in, and we'll talk again next week, same Saturday, 2 o'clock. Sorry, 10 o'clock Saturday next week. Thank you.
Thank you.
Welcome. Alrighty.